Okay, good morning, everyone. As this class is asynchronous and we see that no one is here, although you can take the live class as well. Let's start with the topic as we have to record these lectures and later on you can see it as well. So we see here uh, raising capital. So that's a topic of today's discussion. And I divide this topic into three parts, part one, part two, part three. I'm going to discuss one by one each part. So the first one is regarding that how we can raise capital. The important point for here that when you do business, you need capital to run the business, to buy the assets to do business like plant, machinery, equipment, all these things. So how you can raise this capital to do the business? Now, capital can be either you can take it as an equity or you can take it as a loan and do the business. Uh, so in a corporate world, when we are talking about the capital, so the capital raising can be done through either by issuing equity shares or stocks, or the by issuing bonds to the public or to any specific people to get money to do the business. So let's start, and we see that how we are discussing this concept here. The key ideas that we want to discuss here is one important aspect of raising capital is a venture capital companies. Uh, it's in the modern corporate world nowadays. The people with the new ideas, new products, they go to the venture capital companies and ask for a capital, ask for a funding and for their business. And by this way, they launch their product and their business starts growing. This sort of arrangement is called as a venture capital, and we will discuss in detail. With reference to this venture capital, there's a very famous show on Canadian TV, which we call it as a uh, Dragon's Den, in which there are famous four or five entrepreneurs or the owners of a big corporations. They are sitting there. The people go in front of them and present their products or ideas and all these things uh, in front of these people. But these people are sitting there as a venture capitalist. So they, after analyzing or after their presentation, they can offer them certain capital amount of money as a capital or as a loan to do that business, or maybe sometimes they reject the ideas as well. They think that there's no business sense in that. So that's the way that it works. But in the formal market for venture capitals, these are companies. You go there, you present your ideas, but this is just a show. That's what I want to explain you through that show is that there is a way that you can generate funding to do your business, and that's what we call it as a venture capital. The second thing what we're going to do here is that how the securities are sold. That's an important point to know here, that how the securities are sold to the public and the role of investment bankers. Now, investment bankers are, you know, that there are two types of banks. One is a saving bank, like those banks in which we have an account, like BMO, or but they also have some sort of separate department or some special separate subsidies in which they run the investment banking activities as well. But investment banks are specifically their job is to do investment for their clients, for their customers, and they do one activity which we call it as an underwriting, and we will discuss in detail about that underwriting. What is underwriting? How they do that? What is the objective of underwriting? So this is the so understand initial public offerings and cost of going public. So we also see that how the firms, if they want to sell their stocks or their shares to the public, not to a very specific corporation or very specific person, but to the general public. Then what is the process and how it starts and how much it costs the company that when they go for a public. Then the last thing we will know is what are the right issues, because the capital can be raised while you are already in operation, you are running a firm and you need to expand. And when you want to expand, you need finance. So there is a possibility that you request the existing shareholders that you increase your investment in this company. And by this way, we want to expand. And this is what we call it as a right issue. So we will talk about the right issue to the existing shareholders and how uh, uh, how to value these rights. So these are the four points we're going to discuss. Venture capital, securities are sold to the public, and role of investment bank, which I explained you the underwriting process, and the public offering to the public, and what is an impact of the those on the or the cost of doing going to the public. And then the last thing is that what are the right issues. So venture capital, as I mentioned, that these are the firms that they want to do. The word is derived from the adventure. So they want to do an adventure in a new business, and how they can do this. That they're the people with the new ideas, new products, new things. So they ask for money, so you invest in that, and by this way you are able to get it. So private financing for relatively new businesses in exchange for stocks. That's a venture capital. That's a definition of a venture capital. The ultimate goal is usually to take the company public. Normally, the process is like this, that the new firms with a very little capital, their own money or funding, what they do, they initially go for a venture capitalist to promote your product, promote your business, and then ultimately the firms have to go to the public for their selling their stocks to the public, and what we call it as an IPO, initial public offering. So venture capital is a stopgap arrangement, or it's a stopover arrangement in order to go to the destination. That's a destination is to go for a public company in which the shares are owned by a general public. The ultimate goal is that. Uh, so many venture firms are formed from a group of investors that pool capital and then have a partners in the firm decide which companies will receive financing. Many firms are working as a venture capital, as purely as a venture capital, but there are firms, they are doing different business, but they develop a certain within their own organization, a desk or a department that do venture capital. The objective behind that is that these type of these IT companies or these companies who are in social media, what they do is that they develop a venture capital within their organization. And if someone develop a new app or new software or new thing, so what they do, they say, okay, bring it to us. We will finance you, and then they use that product for their own platform, right? So this is the way that it works. Like the companies will receive financing. So some large corporations have a VC, they have their own divisions. Just I gave you an example. Now, it is important and it is very advisable that when you are selecting your venture capitalist, because you are going to do a contract with them, and when you are doing a legal contract with the venture capital, so you have to be very careful that you are not indulged. You invented a very good product, and because of your contract or the venture capitalist is not fair with you, so maybe that's going to be your situation is going to not be going to be benefited with that invention. So look for a financial strength, how much financially strong those venture capitalists are, or the firm that who are doing. Choose a venture capital that has a management style that is incompatible with your own. So you have to go to the venture capitalist and see that how they are managing their affairs. If they have a compatibility with your way of doing business, so then it's good that you select that venture capitalist. Obtain and check references. Definitely, you have to look at their situation and their market reputation. Definitely, it's like that when you buy a very small product online. So what you do, you read the reviews. So similarly, when you are doing this big thing with you are signing a contract with a venture capitalist. So you have to be careful to see the references as well as their reputation in the market. So what contacts does the venture capital have? So what their offers? You must consult some specialist that what they are offering and what you are accepting. So you have to be very careful. And the last thing, which is very important, that how you must go the with the venture capital, but uh, uh, keep a door open to exit from that contract. And how they design this of exit strategy, that what is an exit strategy from this venture capitalist if you need that. So that's an important thing. Now this is the way that it works at a very small level, at a very small scale, or you can say on a trial basis, on a trial scale. But when you want to further expand, or you want to need a lot of funding, then definitely you have to go to the public. And the public issue is a way that you can generate more funding. But definitely you need first some platform through which you can launch your product, and venture capital is one of them. After launching a product, and if your product is successful, your business is growing, then with those credentials, like your sales, your revenues, your profit from last 1 or 2, 3 years, then you are able to go to the public, because public is only going to believe you after your results, which is in fact with facts, like, okay, we did this business from the last 2 years, and we have this much sales, and the growth of the sales and the profit and all these things. So that is required for going to public. As one fine morning, if you get up and say, okay, I want to sell my shares to the public, how you can do that? You have to some credentials. So the creation and sale of securities that are intended to be traded on the public market. So when you are going to public, the objective is that your share is going to be sale and purchase at the stock exchange, public market, which can be a stock exchange. All companies on the Toronto exchange come under the. So for that reason, definitely you have to register yourself with the Securities and Commission jurisdiction of the respective stock exchange. In Canada, we have a Toronto Stock Exchange, and all those firms who are traded on Toronto Stock Exchange must be registered with the Ontario Securities Commission jurisdiction. So that's the way it operates. Now, when you want to sell securities to the public, so what you have to do, the first thing is that you have to get a permission from the board of directors that you want to go to the public. Then prepare a document, which we call it as a prospectus. Prospectus is a book, and that can be for any purpose. It can be for selling a new homes. It can be for a college. It can be for selling your stocks. So basically, that's a book. It's a preliminary book, and the objective is to give you the detail about your company and about your business plans and all these things. And there are certain requirements, legal requirements, and that legal requirements are set by the Office of Securities and Commission. Securities and Exchange Commission or Securities and Commission like this office, what we discuss, Ontario Securities Commission. So Ontario Securities Commission is going to be evaluate that your preliminary. So first, what you do, you develop a document, which we call it as a prospectus, and submit it to the OSC, OSC and to the potential investors as well. But OSC, the Ontario Securities Commission, studies these prospectus and notify the company of a required change if there is any within 2 weeks. And after that, if the prospectus is approved, the price of the stock is determined and security dealers can begin selling and buying. So this is the way that you have to register yourself to in the office of Ontario Securities Exchange Commission. So this why I'm using the word Ontario Securities and Exchange Securities Commission. The reason is that we are talking about the Canadian perspective. But if it is in New York Stock Exchange, or in Mumbai or Stock Exchange, wherever the stock exchanges are, so you have to register according to the jurisdiction of that stock exchange. So that's now there are for equity sales, there are two kinds of public issues. One is called as a general cash offer, like you get a cash and you offer them the securities. That's one way of doing or selling the securities to the public. New securities offered for sale to the general public on cash basis. And the other one is right offers. New securities are first offered to existing shareholders, and these are more common outside North America. Right offers, as we're going to discuss in detail in the coming slides in the part 3, what is a right offer? So one is a general cash offer that is to the public without any discrimination. Right offers are only to the existing stockholders. So it means that it's a discriminated that, oh, there's no if you don't own any stock, so you cannot get it right offers. Now, what is a method of issuing new securities? There are different methods that we can use for issuing new securities. The first division is whether it's a public or a private. So public is can be further divided into different ways, and private is a direct placement. Like if you are having 4 or 5, 10 friends and they are interested to buy the stocks of you, so you privately sell them and then get the funding, and they become the owners or they are stockholders of your company. So securities are sold directly to the purchaser, who are at least until recently generally could not resell securities for 4 months. So this is the way that private selling is happening. On the other hand, the public is the traditional negotiated cash offer that you offer them a certain firm commitment. Cash offer means company negotiate an agreement with an investment banker to underwrite and distribute the new shares. A specific number of shares are bought by underwriters and sold at a higher price. So what is happening is, this is a very standard practice, that when you want to sell to the public, you are not directly selling it to the public. The way is adopted is that you hire an investment banker, and that investment banker is working as an underwriter. So underwriter is what the bank is going to underwrite is that, okay, these are your securities. We are going to sell it to the public. If the public purchase, we will sell it at this price. And if the public is not buying, then we will buy it. So it's sort of an insurance or something like that. Make it the confidence to the seller that, okay, if the public is not buying, the bank is going to buy. So that's that. But definitely the price difference is the income for the bank. So company has investment banker sell as many of the new shares as possible at the agreed upon price, and there is no guarantee concerning how much cash will be raised. That's a best effort cash offer, firm commitment cash offer, Dutch auction cash offer, direct right of offer, standby right offer. So these are privileged subscriptions in which the right offers are discussed. We will discuss in detail later, but for the public, when we involve the underwriter. So there are three different types scenarios. It's a commitment price in which the price is agreed, best effort price that in which the underwriter is saying, okay, I am going to try my best to sell your stocks as at the highest price, like the realtors, right? You know, you hire a realtor to sell your house. And the realtor is trying their best to sell it at the highest possible price with the commission. Same is the case with the investor or banker. They try their best to sell it. So this is without any firm commitment. The first one is a firm commitment, the second one is without firm commitment, best effort, and the third one is a Dutch auction. So they do the auctions on behalf of the client as an underwriter. And the involvement of underwriter we will discuss in detail in part 3, is to give the confidence to the public, because if the underwriter is involved with a good name, a big investment name, investment bank name, give the public confidence, signal that, okay, definitely this is a good company because the underwriter is a very strong bank. Underwriter is a very financially sound and very technically, and they are very competent people. So that's the way that it operates. Now, IPOs and SEOs, IPOs, initial public offering, and that's important to remember or understand. New, unseasoned new issues, a company's first equity issue made available to the public. That's what we call it as an IPO. And the other one is a seasoned equity offering, a new issue for a company that has previously issued securities to the public. So they want to issue a little bit more because uh, there is an opportunity of investment or to expand the business, and the market is very favorable. So what they do, they sell more stocks to the public, and by this way, they generate funding for new projects. So this is all what I want to share you from this perspective, like venture capital and public selling.